April 2nd, a day President Trump calls Liberation Day. But for India's export powerhouses, it could be a day of reckoning. A 25% tariff on imported vehicles and auto parts is now in force. How will it shake up India's economy, global markets, and your investments? Let's dive in. For decades, the US has bought far more than it has sold, building a massive trade deficit. In 2024, America's trade gap with India alone surged to $45.7 billion, up 5.4% from 2023. Trump sees this as an economic imbalance, claiming countries like China, Mexico, and India have an unfair advantage. His fix: tariffs. Trump's logic: make American-made cars cheaper than imports. In theory, this could mean more jobs in US auto factories, a reduced trade deficit, stronger domestic supply chains. But there's a catch. Tariffs also increase costs for companies importing raw materials. Automakers relying on foreign parts may pass those costs to consumers, leading to higher car prices. India is one of the fastest-growing auto exporters, with $7 billion in US-bound shipments in 2024. This includes $1.2 billion in passenger vehicles and $5.8 billion in auto components. With a 25% tariff, this industry now faces a crisis. Who gets hit the hardest? Car makers: Tata, Mahindra, and Maruti Suzuki, which exported 280,712 units in FY24, may see declining US demand. Auto parts suppliers: export losses could reach $1 to $1.4 billion annually, pressuring the rupee and widening the trade deficit. Jobs and IT sector: production cuts may trigger job losses, while escalating trade tensions could impact IT firms reliant on US contracts. India can't afford to sit still. The government has options. Seek exemptions. Negotiate tariff relief for key auto exports. Trade realignment: shift focus to alternative markets like Europe, Southeast Asia, and Africa. Tariff retaliation: impose counter-tariffs on key US exports to India, like agricultural goods. India must move swiftly, either through diplomatic negotiations or by boosting domestic demand to offset export losses. A slow response could mean slower growth in auto exports, reduced foreign investment in manufacturing, rupee depreciation due to trade imbalances. India does have levers to play this game safely, like leveraging its large domestic market and striking new trade deals beyond the US. In the immediate aftermath, expect auto stocks under pressure due to export concerns, information technology stocks reacting to US trade tensions, select manufacturing and domestic-driven stocks gaining strength. Short-term volatility is expected, but long-term investors should focus on India's internal growth drivers, sectors like infrastructure, defense, and renewable energy. Here's how investors can stay ahead. Diversify portfolios. Reduce reliance on auto and IT stocks. An investor holding Tata Motors stock might see short-term declines, but a diversified approach, adding FMCG stocks like Hindustan Unilever, could balance risk. Focus on domestic sectors: banks, FMCG, and capital goods. Stocks like HDFC Bank, ITC, and Larsen & Toubro could provide stability. Use corrections as buying opportunities, quality stocks at lower valuations. Track global cues. Any sign of US-India negotiations could shift sentiment. Volatility is temporary, but strategic investments in high-growth areas will yield long-term results. Trump's Liberation Day might shake global trade, but India has the resilience to turn challenges into opportunities. Stay informed, stay ahead.